Welcome back, everyone. This week, we're going to talk about Tidewater. Them and many of the other offshore names released their Q3 numbers in the past week. We're going to go over Tidewater. So let's jump into this, see what things are looking like. I think they're looking pretty good myself. So the only problem, of course, is this looming recession everyone's talking about, in which this name will do absolutely atrocious, more likely than not, if that occurs, unless it's one of those inflationary commodity boom type recessions. But things aren't looking the best for that, with WTI being in the high 70s, low 80s range. So it'd really have to take off. But who knows? That's beside the point and a topic for a different day. So, Tidewater. Third quarter 2023 highlights. Revenue of almost $300 million, a 39.2% increase from the second quarter of 2023. Average day rates increased to $17,865 per day, which is a $1,823 higher than the second quarter of 2023. Composite leading edge term contract day rates are up 21.7% to $28,609. Net income of $26 million roughly, an increase of $3.6 million from the second quarter of 2023. If you haven't noticed, some terms to describe this might be up and percentage increase and looking good. Incremental progression, which is really the whole underpinning of my thesis for offshore. Adjusted EBITDA of $117.2 million, an increase of $45.2 million from the second quarter of 2023. Complete integration of the 37 recently acquired PSVs from the Solstad offshore acquisition. Initiating 2024 revenue guidance between 1.4 to 1.45 billion and 2024 gross margin guidance of 52%. Now, the problem with some of these is, well, what's the gross margin at now? Is 52% better? Is it a lot better? Is it worse? Is it less worse than what was expected? And the answer is it's improving. Yet again, gross margins are improving. Day rates are improving. Utilizations, are improving, depending on how you want to look at that one. EBITDA is improving, margins improving. And announcing share repurchase authorization for the maximum permissible amount under existing debt agreements. So there'll be a lot of reading, but there'll be some pictures in this. Sit back, relax, have yourself a cup of coffee, a nice Paloma. The Quinton, CEO, Tidewater's president and chief executive officer, commented, "The third quarter marks the third consecutive quarterly cyclical revenue and global average day rate high water marks. Third quarter revenue nicely exceeded our expectations as a continued push on day rates globally drove consolidated day rates up approximately $1,800 per day sequentially, representing the largest sequential improvement in day rates since the recovery began. The pace of day rate expansion was largely a combination of legacy contracts rolling on to current market day rates and a meaningful step up in leading-edge term contract day rates. Leading-edge term contracts increased to $28,609 sequentially, an improvement of approximately $5,100 per day over the same measure in the prior quarter. The momentum in day rates is being driven by a global supply shortage of large and small offshore vessels, and in fact, our medium and small classes of PSVs showed the most relative improvement in leading-edge term contract day rates during the third quarter. We remain confident in the outlook for the business as demand for our vessels remains robust across a variety of end markets, including offshore drilling, subsea, construction, offshore wind, and existing production work. This confidence allows us to initiate revenue guidance for 2024 of $1.4 to $1.45 billion and initial gross margin guidance of 52%. which is driven by our projection of an increase in year-over-year day rates of over $4,000 and an annual utilization level of 86%, increases that are in line with our recent quarterly improvements. On a global basis, revenue, gross profit, utilization, and day rates were all up from the previous quarter. Revenue for the quarter totaled $299 million, an increase of blah, blah, blah. We just covered a lot of that. We incurred approximately $6 million of acquisition and integration-related expenses associated with the acquisition of 37 PSVs from Solstad Offshore. As of today, we have 32 of the acquired PSVs integrated. Already covered that. We now anticipate fourth quarter 2023 revenue of approximately $309 million, and that gross margin will be approximately 47%. Okay, so you hear that. So their gross margin outlook for 2024 is 52%, and then their outlook for Q4 2023 gross margin is to say 47%. And then whatever the gross margin is, which is somewhere in the 40s range for Q3, which was better than the quarters before that. So positive, inflecting trajectory. Everything's looking good. Actually, if anything, in my eyes, this could be confirmation bias or ignorance of contributing factors, but it's kind of making me nervous between this recession narrative in which these things will do terrible for quarters and really make me feel stupid. I don't like when things are looking too good. You know, it makes me nervous. It makes me nervous. So we're going to cover some of the conference call material, and a good section of it was them discussing and noting different subsegments and of geographical locations between the Americas fleet, Asia Pacific, Middle East, Europe, on and on. So I just want to touch through this and simply point out that in most all of these, for the 3 months ending September 30th, utilization improved, active utilization improved, average total vessels went up as a consequence of the Solstad acquisition. Average stacked vessels pretty much stayed the same, and average active vessels increased Solstad acquisition. So that's good. Now, the 9 months, I will point out to this, the 9 months, let me see, this might not be the chart. Things are looking pretty well on the 9 months as well. Oh, I think what I wanted to point out was worldwide fleet utilization. So for the 3 months ending in June 30th, that was a very long pause, my apologies. It went from 76.9% to 80.5%. Active utilization went up. Average vessel day rates went up, and so on and so forth. Then, I'd like to note that there's really no spare capacity. You see, total active in their fleet is 219. Total stacked is 4. So, altogether, they have 223 vessels. 219 of them are active. It's not like they can keep adding more vessels. Like, they're done. So at this point, insofar as all things, staying equal or improving, they're going to get higher and higher rates, which is what they're projecting for, $4,000 incremental progression. And that's worthwhile to note. So when they talk about the shortage, this is what they're talking about. It's not as though they have numerous vessels stacked ready to be deployed. That's not a thing. So over the week, and this does matter because there's a sympathy trade to some extent, Oil at one point was down 7-ish%, close the week down, call it 4.5%. Now, with the things that I've just noted to you, you might think that Tidewater would at least be trading flat, but it's trading flat after it dumped a bunch. I think at one point it was down in the week, it was down 19%. Might be right, 17%, 19%. And then so it closed the week down, we'll just call it 15%. So that's pretty rough. Now, as a side note, this is a good chart. You could say things trading down at a discount to replacement cost. Like, what does that mean? Like what's the asset value? Or there's different ways. You have net present value or the market value versus book value. And there's all kinds of ways to assess what something is worth. So I like this post. Transocean valuation in historical perspective. The enterprise value equals a 36% discount to asset value, which is 0.7 standard deviations cheap on the mean premium of 4% since 1993. Reversion to the mean implies roughly $18 per share. And we'll zoom in on this chart. And essentially what this is the chart shows enterprise value compared to the asset value. So right now, it's trading at a discount. And then oftentimes, in good bull markets, they can trade at a premium. So do you get out when it reaches fair value? Or do you get out of half your position, fair value, and then hold on for the other 50%, 100%? Depends on you, but I thought this was a good, interesting chart to kind of just simply illustrated these dynamics. But back to Tidewater, because that's who we are talking about today. And now we're into the actual conference call. They say the Solstad acquisition transaction was an asset purchase, so it lends itself to a more streamlined realization of G&A, general and administrative, synergies, as we didn't have to onboard any personnel not immediately pertinent to the supporting newly acquired fleet. That dynamic played out as expected, and now that we have a substantial majority of the vessels inside of our infrastructure, we now expect the incremental annualized G&A for the new fleet to be about $3.5 million as compared to our initial view of $5 million, resulting in implied G&A synergies of $14.3 million and an incremental per day G&A cost per vessel of $260 per day. This is simply unmatched in our industry. It's always nice when you see a company do an acquisition and actually have synergies, because a disproportionate amount of the time, that's not the case. And sometimes it even costs them more, interestingly enough. The company's debt agreements allow for the repurchase of up to 50% of the company's trailing 12 months net income beginning on November 17th, 2023. Accordingly, we announced in the press release that our board of directors has authorized the company to repurchase up to $35 million of our outstanding common stock, which is the maximum we can do at this time under those debt agreements. We will update the repurchase program quarterly based on our utilization of the program and the permanent amount available. So if you see over here, adjusted weighted average common shares, it's close enough ballpark figure. Other figures do 3 months ending, 9 months ending. There's a few other places that you can find weighted average common shares and then diluted shares, but 52.5 million roughly. It's fine, like if we have to be precise, then we don't have enough margin of safety. So some simple math, 35 million share repurchase, call it $60 per share, 583,000 shares. That's roughly 1% of diluted shares, or actually I don't know if that's diluted or not diluted, but diluted only adds a couple million more. So it's still roughly 1%. Rough numbers here. So the share purchase is 1%. of shares outstanding, roughly. Now, and we'll get into this in a moment, due to the share price doing so well this year, up 80% or something like that, some warrants got activated. So the share repurchase that they're actually doing only accounts for a quarter of the warrants exercise, which further diluted shareholders. So currently, I mean, this is just foreshadowing what's to come and more repurchases down the road, but don't get too excited. First of all, with the share repurchase, it's a major step. Don't get me wrong. I don't want to discount it too much. I just want anyone listening to understand that it's not going to ramp the stock up because of illiquid, trading, and it's just like it's meaningful, but let's not get ahead of ourselves, is what I'm saying. Go on to say in the conference call, the positive momentum in the offshore vessel market continued during the third quarter. Tidewater continued to benefit from the global uplift in day rates driven by the increasing demand for vessels and tight vessel supply, with day rates up over $1,800 per day and 11% movement from the last quarter. This is the largest absolute and percentage sequential quarterly day rate increase since the recovery began. The average day rate is now up approximately $7,200 per day, or nearly 70% since the recovery began around the end of 2021. Every region and every vessel class experienced a modest to quite significant day rate increase during the third quarter, which speaks to the global tightness in vessel supply-driven day rates for every vessel class. The global uplift in our day rates is comprised of two major factors. The first of which is older contract. This is kind of important, so pay attention. Snap you out of the lull of my voice. The global uplift in our day rates is comprised of two major factors. The first of which is older contracts rolling off and recontracting at prevailing market rates, allowing us to continue to mark-to-market our fleet. The second factor is that leading-edge term contracts continue to move meaningfully higher. During the quarter, we executed 27 term contracts with an average rate of approximately $28,600 per day, with new contract distribution essentially in line with our vessel distribution. This compared to the leading-edge day rate in Q2 of approximately $23,500 per day. This represents a nearly 22% sequential increase in leading-edge term day rates, essentially double the rate of sequential growth from Q1 to Q2. Further, the Q3 leading-edge term contract day rate was approximately 60% higher than the Q3 printed day rate. There's always a trade-off between utilization and day rate when you are holding out for the best prices, and this quarter is more than worked out. Now, if you go back, what I meant to do was those subsegments of geography of the market, that chart I showed you. If you look at 9 months ending, what you'll actually notice is that day rates went up. I believe it's that chart, or it's when I'm getting ready to show. Honestly, I can't remember. What you'll see is that utilization rates 9 months ending in September actually dropped, but the day rates more than compensated for that drop in the utilization rate. That's why you have to cross compare all of these, backlogs, utilization rates, day rates, new builds as a percentage of global fleet. And even if one is going down, such as utilization rates, then you need to check out the other ones. What's going on with them? In this case, as they're noting, day rates still are improving. So let's continue. We are still contracting short, but the average duration of the new contracts in the third quarter was approximately 10 months, slightly higher than the 6.5 months in the second quarter. The uptick in duration is attributable to a few long-term contracts for some of our smaller tonnage and lower specification vessel markets. As we have talked about in the past, there is an iterative process as day rates reset where one boat class moves up as the day rates increase, customers will begin to look to find adequate substitutes in adjacent vessel classes where appropriate for the given work scope. So essentially what that means is, say you have vessels, 1 being the worst, 9 being the best. Right now you're buying the number 5 vessel. But as the number 5 vessel increases in price, you then say, hey, we could probably use that number 4 or even that number 3 vessel and get the best bang for our buck. The number 5 vessel has ascended beyond cost levels we're comfortable with, so let's compromise. That's essentially, if you didn't understand, hopefully my poor example clarified things. As we have talked about in the past, there is an iterative process. As day rates reset, one boat class moves up. As the day rates increase, customers will begin to look to find adequate substitutes in adjacent vessel classes where appropriate for the given work scope. As day rates in the smaller vessel classes approach parity with larger vessels have taken the next leg up. We saw that dynamic play out this quarter, where the most relative day rate improvement came from the mid and small vessel classes. We are encouraged by this dynamic as it's the natural progression of day rates across the vessel spectrum in a supply-constrained environment. Soon enough, people will run out of ships and PSVs to downgrade on to save money, is what he's noting. We anticipate that as we enter the more active tendering part of the calendar in the first quarter, that we will continue to see day rate momentum in all of our vessel classes. People are running out of places to hide to save money. So, to sum things up, monotone voices are not the best. Day rates increasing and uniform improvement across all segments of the market. And by uniform, I mean that all segments of the market are seeing improvement, even though the improvement is different. So uniform is probably not the best word. Older contracts are rolling off, re-rating higher on leading edge term contracts. However, some of these contracts rolling off are rolling off into longer term contracting, i.e. 10 months instead of 6.5 months. Discipline is another key tenet, and whilst a lot of our focus since the recovery began at the end of 2021 has been on pushing up day rates, we have also been very focused on getting our charters to agree to more actual contracts which either remove the termination for convenience clauses completely or significantly improve the termination provisions. Whilst Tidewater is very focused on this issue as we agree to new contracts, we believe that the industry must be equally disciplined regarding termination revisions to help build a long-term sustainable growth industry again. Now you might be asking, what is a termination for convenience clause? Well, I'm glad you asked. A termination for convenience clause is a contractual provision that allows one party to terminate a contract without having to establish a breach of contract by the other party. It gives the terminating party the right to end the contract for any reason or for no reason at all, as long as the termination is done in good faith. Termination for convenience clauses are commonly found in various types of contracts, including government contracts, construction contracts, and commercial agreements. These clauses provide flexibility and protection to the terminating party by allowing them to exit the contract if circumstances change or if they no longer need the goods or services provided under the contract. Conference call goes on. In addition, the steep increase in the value of our common stock in July resulted in previously out-of-the-money warrants becoming exercisable prior to the expiration on July 31st, 2023. This resulted in about 1.9 million shares of stock issued for a total of $111.5 million. Here you will see exercise of warrants. This would be from the cash flow statement, cash flows from financing activities, exercise of warrants, $111 million roughly. So we're about done here. So I have this slide and one more before we get to the weekly stock portfolio review. So to sum things up, this is, I've highlighted here in red, going back to September 30th, 2022, so 1, 2, 3, 4, 5 quarters of improving vessel operating margins, of improving utilization total fleets, and improving average day rates. So 1 year ago, vessel operating margin was 40.6%. Now it's 44.7%. Utilization total fleet went from 77.8% to 80.5%. Average day rates, that went from 13,606 to 17,865. And then it's not, vessel revenues, we can go there. Went from 190,000 roughly to 296,000. Please understand, thousand means million or hundreds of, 296 million. Hopefully you understand these things. If not, you're in trouble. Vessel operating costs. You can see crew costs, so crew costs went from 71,000 to 97,000. Repair and maintenance, 13,000 to 23,000, which is going to happen when you're restarting, let's just call it, optimistically, a bull market. Things have been cold stacked. They need the kinks worked out of them. So I think they even noted that on the conference call. Insurance stayed pretty flat. Fuel, lube, and supplies, 12,000 to 17,000. So it's not like, and you can tell by the vessel operating margin that costs aren't getting blown out. And that's good, because that allows these higher day rates to drop to the bottom line. And then we have the next one of the influence of EBITDA and adjusted EBITDA. Those two are improving. EBITDA went from 46,000 to 109,000. Adjusted EBITDA went from 52,000 to 117,000. Seems like they need to take a note from the tech bros and really adjust the hell out of those EBITDA. I feel like if normal EBITDA is 109 and adjusted EBITDA is 117, they're not adjusting enough. You know what I mean? I say that jokingly. Thank you for watching this segment. And let's start off the next segment of portfolio review. For those who don't know, new to the channel, if you're still watching, I own Tidewater. I actually bought an additional share, which diluted the hell out of my percentage gain as a consequence. But I added a share of that, and that pretty much ends the Tidewater segment. So, stock portfolio review time. Gold is being absolutely, not gold itself, but gold miners, precious metal miners, are being absolutely destroyed. You will note that I did, in fact, couldn't help myself. I did, in fact, add Franco Nevada to my portfolio. Right, wrong, smart, I don't know. Interestingly, the price action, like I noted, pretty much all precious metal miners are getting wrecked in the past, week and longer than that. And Franco actually is holding up pretty well. Now, you can say in part it's holding up pretty well because it took a good hit recently for other related reasons. But to see that people aren't piling on and just dumping the stock harder is slightly promising. It's holding up fairly well. And triple flag, that, it's not, the precious metals aren't looking the best. The miners aren't looking the best at the moment. Let's see what we got going on here. It's really frustrating, some of these things. And this whole recession thing just has me bothered. And I could see something happening. There's a few charts I've looked at. I did not put them in here that kind of make me wonder if something's going to happen. Q1, Q2, I don't know. It's hard because, so in part, I plan on stacking some cash. I'm at 2% cash. That's embarrassing. I mean, I just might sell something. I don't know what. Surge Pay's doing well. Town Square's doing well enough. I'm up on both of those. DRS, up a few. I mean, all of these gains could be erased in a single day. So keep that in mind. It's not by far the least volatile portfolio you're ever going to set your eyes on. So unless something's up more than 20%, just know that all my gains could get wiped out in a given day. So it's really frustrating that here Transocean, something I've owned since January and have bought some dips on, which you could say I've done well enough at buying dips to not be too horribly hurt on the year, but it's really frustrating to own something that's doing well in a sector that's doing well, and essentially I'm down technically 3.33%, but to be essentially flat. And what's really frustrating is Tidewater, Transocean, what else? Valaris, all these names have pretty much erased all their gains since, call it July. So July, August, September, October. So in a couple of weeks, call it 4 to 4.5 months worth of gains wiped out. Which is frustrating to say the least. My portfolio, I think I was down 5.5%. I really need to start posting it, like first video of each month, my prior month's performance. I really need to do that. But last month, I actually was down. I thought it was down like 8% on the month, but I was only down 5.5%, with the S&P down, my benchmark down 2.5%. So I underperformed the S&P by double. So that's the problem. That's just is what it is. So looking throughout this year so far, I have 2 bad months in a quarter, and then essentially a 10% month each quarter. And that played out for the first quarter, second quarter, and third quarter, and here we are halfway through the fourth quarter. Who knows what will happen? I don't. So that's kind of the portfolio review. I don't really have anything more to add to that. Earnings season is pretty much over for my portfolio, so I guess there's not many catalysts. But earnings, can really be volatile, so see what happens. Got a lot clipped a lot of dividends, or I'm getting ready to clip a lot of dividends, which adds a few percent. Like Town Square's dividend I'm at 8 some odd percent, but then you got Franco Nevada, which is like 0.8% dividend, and then Joe with let's call it 1%, and the Kinross, I don't know, I have a lower cost basis, so I think I got in at 3%, and then some that just don't pay, but it adds a couple of percentage to the portfolio over time, so that can make or break a month, a quarter, or a year when it comes to, basis points matter. So I think I'm going to end it here. Thank you for listening. Thank you for watching, and have a good time, and until next time.